Welcome back. Hello, everyone. I'm Vern Cushenberry, Chief Investment Officer, and I'm back with another quarterly market update. As of September 30th, the markets were nearly flat for the quarter, a little bit of volatility, some new concerns on investors' minds. And I want to address some of those today and give you an update of where the market is and what we're seeing. So here's the economic and market data that we generate on a quarterly basis, and you'll always hear me start with returns, and you can see that on this chart here. It shows what's been happening in the market since '96, really, and since the market bottom of 2020 when COVID hit, we're up 93%, and you can see a little bit of a give back there, but valuation ratios by and large are still very robust. Robust might not be the right word. You might call them elevated, but you can see the index level price to earnings ratio is now about 20.3. Dividend yield is about 1.5 on the S&P 500. Let me put that in context for you here real quick, which is this next chart that we share with all of our investors. This measures price to earnings ratio going back to 1996. And you can see that generally speaking, somewhere down around 13 is considered to be cheap-ish. Somewhere up around 20 is considered to be a little bit more expensive. And we're up on the more expensive side. And if you measure that by dividend yield, by price to book, by price to cash flow, there's a cyclically adjusted PE and then standard PE. All of those metrics are a little bit elevated, which should give investors pause. We know what's been going on in the economy. That's COVID. COVID caused a significant contraction in corporate earnings. Well, when you look at valuation as measured by price to earnings, earnings is the denominator. So when the denominator shrinks, naturally valuation ratios are going to go up. Now, if that's a short-term or temporary phenomenon, then probably not a lot to worry about. And that's certainly what Wall Street is expecting, and that's what we've been monitoring, and we need to see earnings catch up with the economy. And the Federal Reserve and our regulators have been playing a big part in that by pushing nearly $4 trillion worth of stimulus back into the economy over that time span. And here's what those expectations look at. If you look at this chart on the left, you can see the earnings per share for the S&P 500 back to 1988. And, it's been healthy. Now we get to the end of 2021, going into 2022, and you can see in the blue here what earnings expectations are for the next 3 quarters. Now, if we can accomplish that, then the elevated valuation levels are probably of little concern. But we really need to see the economy revitalize. We need to see the economy get back into full swing, so to speak. And we're doing that. Slowly, we've seen a rebound in earnings, which is what this chart on the right shows us. If you look at the gray bar, that's earnings growth. So earnings are growing. The economy is expanding. We're in a bull market. Those are all good things. Now, the price return on the S&P 500 is a combination of several things. It's a combination of earnings growth, which is that denominator, and it's also a combination of the multiple, which is how much is an investor, how much is our investors in general willing to pay for a dollar's worth of those earnings. And you can see the green is the price return, and the blue is the multiple. So just like I showed you on the last slide, that price to earnings multiple has been declining a little bit, which is fine. That won't cause a significant price decline as long as we see continued earnings growth, which is the dynamic we're paying very close attention to in this market. Last quarter, I talked quite a little bit about inflation, and you'll hear me continue to talk about inflation until we have some level of assurity whether or not this is a temporary phenomenon. The Fed governors have taken the stance that this is likely to be temporary, but they've measured some of their commentary in the last few months. There are some enduring aspects of inflation that have begun to creep into the economy, and you can see that here on the right-hand side of this slide, which shows labor. This is labor share of income and profit margins is what we're looking at here. So if you chart the gray line, which is labor, you can see that it had been declining significantly. This chart goes all the way back to 1950, had been declining significantly since the late 70s. And then just here recently, we've seen a significant spike. That spike in labor, which is wage inflation, is the most meaningful hallmark of future inflation. We pay a lot of attention to that because more so than about anything else, maybe commodities, it has historically been a pretty good harbinger of inflation on the horizon. So we're watching that. Now, there's a lot of other aspects at play there, including stimulus measures that were provided for COVID. You take some of those away. A lot of the pundits on Wall Street think that we may see greater labor enter the marketplace for jobs, and see a lot of those imbalances naturally correct themselves. That's as of yet to be seen. So we continue to monitor it. Now, I don't want to paint this economy, I don't want to paint this market with too broad a brush, because when we look at global markets, when we look at the S&P 500, that's a very broad measure of what's going on. And we can break it down a little bit to find pockets of inefficiency or pockets of opportunity. And this chart, there's a lot of data on this chart, but let me break it down for you a little bit here. I'm talking about price to earnings ratio, and I mentioned that threshold is a little bit elevated. So if you look at this top graph here, you can see the price to earnings ratio, the current in the top quadrant there, I'll call it, versus the 20-year average price to earnings ratio. So now consider how we break the market down here. If we're looking at the S&P 500, we're primarily looking at large cap growth stocks. And you can see there that the current price to earnings ratio for large cap growth stocks is 28.6. The 20-year average is 18.5. So yes, stocks like Apple and Google and Facebook and some of these others that would fall into that large cap growth category, they look a little pricey now. But there are other pockets of the market. We can segment the market by large cap, mid cap, small cap, value blend, which is kind of a mix of value and growth and growth. But look at the other end of the market. Look at small cap value stocks. The current price to earnings ratio for small cap value stocks is 16.8. The 20-year average is 17. So there's a pocket of the market that you would call, quote unquote, fairly valued. Again, it's not fair to look at any single ratio to assess what's going on in the market, but a multitude of data inform our decision making, and this is certainly relevant, very relevant information for all investors to be mindful of. So that's kind of a quick check-in on the markets and valuation. I had a question. I love questions. Please send them to me, because that's how I know this commentary is of interest. And one of our retirement plan clients asked me about the Secure Act, asked for an update on the Secure Act. So I wanted to do just that. Now, the Secure Act was passed in December of 2019. Secure stands for Setting Every Community Up for Retirement Enhancement. Secure, SECURE, Setting Every Community Up for Retirement Enhancement. And it's an overhaul of our retirement plan system. And regulators took a look at an emerging retirement plan crisis, which is really the outgrowth of a changeover in our American system of funding retirement from defined benefit plans of yesteryear. I'm sure most of the people that are tuning in have either a defined benefit plan yourself, or somebody you're related to that has a defined benefit plan. And those worked very, very well for a whole generation of Americans until about the early 80s. We started switching over to a defined contribution plan, which left all of the onus, all of the responsibility for funding your retirement on the individual participant. And frankly, if you don't have a master's degree in finance, those outcomes haven't been that good. And you can see that defined benefit plan, those plans, the number of plans available to participants has declined steadily over the last, call it 40, 50 years, while defined contribution plan participation has increased steadily. And our regulators understand that we have a problem. We simply aren't generating the funds to deliver successful retirement plan outcomes for retirees. So what do? Well, we pass a new piece of legislation. And that new piece of legislation is designed to make some of these defined contribution plans look and feel and act like an old defined benefit plan. Well, what's that mean? Well, a defined benefit plan delivered a paycheck for life. You retire, say you retired at the age of 65, you would get a paycheck in the mail. And it was an experience that most retirees could count on. They knew what was ahead of them at age 65. You put your time in and your retirement was secured. Well, that experience, that paychecks for life experience, is called an annuity. An annuity is nothing more than a series of cash flows over a defined period of time that usually solves for longevity risk. It doesn't matter how long you live, that paycheck is going to be there when you need it. Well, annuities are complicated because they don't fit well into a defined contribution plan, or at least they haven't historically. Enter the Secure Act, which is all about delivering a more secure retirement income for life experience to plan participants and solving this emerging retirement plan crisis. So here I have a document that I can share with you. This was published by the Secure Retirement Institute. And they kind of talk about some of the benefits of the Secure Act and what sponsors are thinking through and what their hesitancy has been in the past, and specifically what the Secure Act allows for that should increase adoption. And initially, we're seeing sponsors that are paternalistic, that believe in innovation, that had maybe formerly believed that this type of experience would reduce benefits. Some of those objections are beginning to go away with this act. And it's really here in the next 6 to 18 months that all of the finer points of this act are have now been hammered out and will begin to make their way into the marketplace, beginning with its 3 most important components, which are portability for annuities. Now a plan sponsor can include an annuity in their retirement plan for participants. And if that participant or that sponsor ever chooses to go to another provider, that annuity can be portable for both the participant and the sponsor. Safe harbor is huge. When we're talking about an annuity, we're talking about a series of payments that can last a lifetime. Well, a sponsor has to be assured that if they elect an annuity provider on behalf of their participant base, and that annuity provider, something happens, something unforeseen happens, and they can't make a payment, well, that liability can't ever come back on the sponsor. And the Secure Act makes accommodations for that. They call that a safe harbor. Now sponsors can enter into that space. They can enter into that process of annuity selection without worrying that they're putting their whole business on the line, which is a huge step forward. And then lastly, disclosure. Our regulators recognize that how much money do I need to retire is not a helpful question. And everybody saving for retirement has that question. Well, there's no reason that they should. We can communicate to future retirees in a new language, which is retirement income. And instead of putting an account balance on their statement, or maybe in addition to that, we can start communicating in terms of monthly income. So now your account statement clearly shows, well, you're on track for $2,000 a month in retirement, or $3,000 a month in retirement, or 4 or 5, and every participant understands what that means. Everybody knows what an extra $1,000 means to your monthly income. So these are, and to some extent, these are simple steps that we can all take that are going to change the experience for plan participants. And we're excited about that. We're excited to bring those steps to you. So be on the lookout for those conversations to unfold either in your own portfolios or inside your boardrooms as we consider next steps. Currently, this is what the landscape looks like. Years ago, we had participants just making fund selection for themselves. And then in what you might think of as your default 2.0, default 3.0, we moved to a targeted risk approach. And those were balanced funds, aggressive funds, moderate, conservative. They gave participants more detail on what they were invested in, or at least some language that they could understand, but they didn't do anything to de-risk those accounts as participants approached retirement. And that still left a lot of the heavy lifting to do when it comes to creating better outcomes. Enter the target date fund around 2006. Again, another big step forward. Target date funds actively de-risk client portfolios as they approach retirement. Good, but not good enough. Enter custom target date portfolios. This is a solution that GoalPath has offered for 3 years now, and we've had terrific outcomes. Custom target date portfolios give participants a range of options, and this particular one that I'm speaking of has an accompanying wellness solution for participants to reach out and get help from a real person, which again is terrific, another big improvement. The current wave in our industry, and we're seeing a good proportion of larger 401k accounts opt for this solution currently in the marketplace, is something called a managed account. And a managed account provides a higher level of service to the plan participant, and it draws on more than just age. Think about a target date fund that put every 40-year-old in the same asset allocation. Well, now we have so much more data at our fingertips. In addition to age, we have account balance, we have savings rates, we have wage, we can make some assumptions with regard to Social Security, we can make some assumptions with regard to salary growth, and we've built the algorithms to power a much more customized solution. That's what a managed account is, and it's really become, you know, the next new thing in our industry. This is where we're going to see annuities come into play within that managed account space. And I think to really launch something like this, we're going to need to see them coupled with access to a real coach that can explain the merits of that type of solution in a managed account. And then lastly is financial planning. And there's no such thing as advanced planning inside of a 401k yet, but it's coming. It's coming. This would be obviously your highest fee. So that's a quick update on the Secure Act. I spend a lot of my time in the silo thinking about how we can engineer better outcomes for all of our clients, whether or not that's an individual wealth management client or an individual plan participant. Most of our clients are saving for retirement. Successful retirement outcomes is what we think about 95% of the time here around our shop, and we're very happy to discuss those with our clients. So please send me more questions. I want to talk about what's on your mind, and I appreciate you tuning in. So thanks again, and I will see you next quarter.